Good morning everyone and welcome to Morning Markets from True Potential. Before getting into the performance of asset markets from yesterday, I wanted to remind everyone and invite those that aren't subscribers to join us tomorrow for a very special edition of the True Potential Do More With Your Money podcast. It'll be the 100th episode, so please join us tomorrow. Subscribe on the YouTube channel for that, which will come live to you tomorrow. So looking firstly then into asset market performance yesterday, very much a tale of two different geographies and what was happening there. We saw a weaker performance in Europe over the course of the day, very much feeding on from the performance that we'd seen the previous day in the US. As the US opened, we saw US markets falling as well, down around 2% at one point on the day. But then as the day progressed, we saw some stability coming into the sovereign bond market. We saw equity markets recover in the US over the course of the day, which is feeding positively into what we're seeing in Europe and the UK this morning. A number of factors are really at play in the background as to what's driving the volatility in certain areas of the equity market. And I just wanted to highlight a couple of those this morning. Chief amongst those is the movements that we're seeing in sovereign bond markets, really starting to reflect those interest rate moves that we saw from central banks in the final month of December, particularly what the UK did, but also the indication from the Federal Reserve in the US. So we've seen bond yields, particularly at the 10-year level, move quite significantly over the past 10 days. Looking at the US yesterday, we saw the 10-year yield hit 1.8%, some over a 25 basis point move from the beginning of the year. It did stabilise as we went through the day, closing around that 177 level. So that relative stability, I think, helped the equity market performance in the US. It's not just the US phenomena, we're also seeing sovereign yields move in other regions. So just looking at the UK, for instance, the UK 10-year gilt yesterday was yielding around 1.22%. Some context there from 0.97 at the beginning of the year. And also we're seeing in Europe, German bunds getting very, very close to being a 0% yield from their negative yielding levels. I think the other factor that we have to be aware of that's influencing sentiment as it relates to equities is just we're getting into reporting season. We're seeing companies start to update on their fourth quarter results. What does that mean? We're seeing some of them start to talk about some disruption from COVID-related issues. It's not on the demand side that, if we cast our mind back to 2020, was issue. It's more on the supply, the input of raw materials, dealing with price inflation, and also that factor that we've been discussing a number of times on podcasts and on morning markets, labour shortages, and that really coming through as being a challenge for companies and the potential for wage increases. Just looking at data in the UK this morning, consumption data from the British Retail Consortium continues to show a good performance for December. If we just look at total retail sales, increasing 4.6% from pre-COVID levels, so that's from December 19. So really that strength in consumption in the UK continuing. There had been some concern that maybe some demand had been pulled into October, November, as we saw Omicron start to take hold into December. I'll leave it there for today, but just looking ahead to tomorrow, please do join us for the 100th episode of the podcast. Many thanks.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.